The second quarter report for earnings coming in from Oracle right now. Here are the numbers coming into the newsroom. Adjusted revenue coming in at $16.06 billion. That's a 14% increase year over year. But the estimate had been for higher than that, $16.21 billion. So a miss on adjusted revenue. And that was a Bloomberg consensus. Adjusted earnings per share coming in at $2.26 versus $1.47 year over year. The estimate had been for $1.64, so a beat on earnings per share. Cloud revenue coming in at $8 billion, a 36% increase year over year, and a slight miss from the estimate, which was $8.04 billion. Cloud infrastructure revenue coming in at $4.1 billion. That's up 71% year over year. The estimate had been for 4.09, so about even there. Software revenue coming in at $5.88 billion, and that's down year over year. The estimate had been for 603, so a miss on the revenue for software. And then hardware revenue, $776 million. That is 6% better than last year. The estimate had been for 716.7. So actually a pretty good beat on hardware revenue for Oracle. Let's go to Angelo Zino. He's equity analyst and senior vice president at CFRA to talk about the results. Thanks for joining us.
Great. Thanks for having me.
A bit of a mixed result here. Some misses, some beats. Did Oracle, you think, deliver on what it's promising investors?
Well, I mean, I'd say kind of going into the print here, what everyone cared most about is probably what you can't get out of the print here. But I mean, we did see some good stuff. I mean, we saw the bookings number, I think was about $523 billion. It was slightly above our expectations. That's a good number. It actually showed a little bit more diversification versus what we saw last quarter. They did highlight new contracts with the likes of the Metas and Nvidias of the world. And not necessarily surprised, given they highlighted some of that at an analyst event just about a month and a half ago. But nonetheless, I mean, good to hear. And then I would say, as far as the actual numbers are concerned on the revenue side, it was a slight miss. They're doing well on the infrastructure as a service side, and that's really the growth trajectory here over the next couple of years. It's that cloud build, right? But what was showing some weakness looks like it was more software centric in nature. And, they do have a legacy side to software, but they also do have NetSuite and Fusion, which, is their higher growth areas. And it does look like NetSuite did show some decent deceleration from the prior quarter. So all in all, I'd say that the numbers were fine. But it's all going to be about what they have to say in the call, because that's what investors, are really kind of concerned about. It's the OpenAI issue, it's the debt issue, it's all that kind of stuff.
Yes, shares are trading down a drop of 6% in after hours to 209.48 right now. As you mentioned, this is a company with a lot of debt. And what do you want to hear on that phone call?
We need to hear, some sort of game plan here, primarily. How, if they can, strategically kind of talk about what the cash needs are going to be here over the next couple of years, and at least give some indication to investors that they shouldn't necessarily be feared about Oracle doing too much too quickly. I think that'll help alleviate some of it. I mean, they did increase their debt here over the last couple of weeks. They've now got over $100 billion in debt. You've got the fact that they're probably going to be free cash flow negative over the next 2 to 3 fiscal years, something that we just saw them, they are, free cash flow negative here over the last 12 months. So we do want to hear kind of some clarity in terms of, financing needs, and hopefully, they can come out and say, hey, listen, we need minimal capital here over the next 18 to 24 months, just given some of the recent capital raises. And that could help alleviate some of the concerns that are out there.
The numbers that you're seeing come in for second quarter, is there evidence yet of the AI spending return yet?
Not yet. I mean, and I'd say one of the negatives with the Oracle story here is, given the fact that they've got to do so much here and they're building so much on, initially in terms of the actual data center build-outs, initially the margins are going to be horrific. So it's gonna compress their margins here over the next, let's call it 12 to 18 to 24 months. And it's part of the reason why we did downgrade the stock here. It's the fact that when you look at the margins, the fact that a lot of the CapEx is going to go into the actual data center and not necessarily as much into the servers, there's going to be less revenue, tied to that. Where it really starts accelerating is as you go into some of the out years, right? Fiscal 27, 8, 29, where you can get more revenue tied to these data center builds. So initially, you're going to see some margin compression. You're not going to see as much of maybe a revenue kind of ramp to kind of justify some of the spend, and that's definitely going to be a negative, and why you're going to continue to see the negative free cash flow here over the next 2 to 3 fiscal years.
Can you do a quick sort of contrast and compare for us? Because we know a lot of the companies are spending on AI and the numbers are huge, but what puts Oracle in the specific position it is in compared to some of the others and how they're spending?
I mean, listen, I think when you look at Oracle, they're generating actually good cash flow from operations. They're going to generate about 25 to 30 billion in cash flow from operations this year. The problem with Oracle, or the Oracle story, if you're looking at it from a debt perspective and a free cash flow perspective, is they've got this hockey stick type of growth in terms of their infrastructure as a infrastructure business. So when you think about that, they're looking to essentially 9x their revenue here over the next 5 years on that side. So their CapEx spend is going to go from, let's call it 35 billion this year to 85, 90 billion on an annual basis by the end of the decade. So it's going to take time before you can actually see that revenue trajectory really ramp up to kind of match that free cash flow, which is why they're in the conundrum they're in. And the fact that the matter is, listen, they're coming into this already in a heavily net debt position, in the sense that they've made a ton of acquisitions here over the last 2 decades, right? And they've leveraged the balance sheet a lot to do those acquisitions. So they were coming into this already with a lot of debt. So when you compare them to the likes of a Microsoft or an Alphabet and what they're doing with their cloud initiative, one, they're trying to kind of accelerate that growth to a much greater extent to the others, because they've only got 2% market share on the cloud side. But the other fact of the matter is, listen, is they're not generating as much free cash flow as these other companies as well.
All right, Angelo, I'm going to leave it there. Appreciate you joining us on this. Angelo Zino, equity analyst, senior vice president, CFRA.